Let's talk about 6 price action secrets that you absolutely must know about. So hello, welcome back, and I've prepared a very special video for you, and we're going to take a look at various price action trading secrets and just general tips, some strategy parts and other things. I also want to remind you that you can leave a comment in the description below, and I will personally answer all the comments that come in. So make sure to really use that, interact with me, and I look forward to hearing from you. So let's get into this and let's get started. So those are the 6 price action secrets that we will take a look at. We're talking at deceleration and acceleration. What does it mean? Price divergences. We take a look at fake outs, breakout buildup. We take a look at the 1, 2, 3 fib strategy, and we're going to take a look at how to find value areas of supply and demand. So a very interesting video is waiting for you, and let's get into this. So deceleration and acceleration, what is it? It is an extended momentum trading concept. So if you know a little bit about momentum, which basically means how strong is the market trading, how is the trend strength developing, then you will be very familiar with those concepts as well. How does the price trade into levels? How does the price react at levels? And how does the price trade away from levels? That's very, very important. So let's take a look at a few screenshots and a few areas of this concept. So when you are in a trend, or when the price is in a trending environment, usually you will see that, such in this case here, in a downtrending market, you will see usually that the bearish candles, the candle moving lower, they are much, much stronger. Here, for example, the price was in a strong uptrend. First of all, the majority of your candles will be bullish, in this case black, and also much, much larger. You can see during this uptrending phase, there were just a few occasions where there were very small bearish candles. Here during the downtrend, there were very strong bearish candles. And whenever a trend shifts or whenever a trend slows down, you will also see a change in this candle sequence or in the candle distribution. So what this means is that when a trend goes on and when the trend is losing momentum, first of all, you will see that now you're going to have more bearish candles. It's going to be more mixed. There's not going to be only bullish candles anymore. You will have more bearish candles. Also, the bearish candles are getting longer and the bullish candles are becoming a little bit smaller. So we can often very, very clearly see this. And this is what you would call deceleration. So when the market is trending for quite a while, at one point, there will come this point where the market decelerates, which means just slows down. And you will often see that based on price action candle distribution and the size. And then here, for example, on the way down, you can see very strong only bearish candles until here. You will see the bearish candles get smaller. Suddenly you have more bullish candles, and then the market reverses. It slows down here. The distribution shifts. Now you have more bearish candles, and then this repeats itself over and over again. Keep in mind, we're just getting started. There are going to be many, many more scenarios that we will take a look at, but this is something that is often overlooked. You need to really look at the whole picture, look at how is the candle distribution. For example, here we have 3 consecutive bearish candles after here those massive bearish candles as well. Here you had a little bit of a pullback, and here the market ultimately really slowed down. So we have deceleration into the top. The market was really slowing down, very small bearish candles. Also now you have more bullish candles coming up. And then here on the way up, you have then acceleration, you have more bullish candles coming, you have a breakout out of this pattern, and the market moves higher. Here as well, you have a strong downtrend, only bearish candles or mostly only bearish candles, small bullish candles. And then here, when the market tops or bottoms out, you suddenly have smaller bearish candles and you start to have more bullish candles as well. And then the market accelerates into new highs here. So this is a very, very common pattern. And you will see this time and time again. The market is in a downtrend. During the downtrend, you have mostly bearish candles. Very occasionally, you have small bullish candles. You can see that here. And then the power shifts, but only slightly. Why? You can see that the bullish candles leading up to these consolidations are very, very small, very narrow. Compare that with the candles that we have seen here during the downtrend. And you will see the comparison in size is very different. So you can see we have a little bit of deceleration into the level. Then we don't have acceleration away from the level. So there's no picking up of momentum. And then suddenly here you can see this candle, you would call that an engulfing candle. It engulfs the previous downtrending candle, uptrending candle, and then the price accelerates away from their level as well. So more and strong bearish candles here. Very strong selling, very strong bearish candles until the market decelerates again into the low. Very small candles, very low volatile momentum. And then here suddenly you have strong bullish candles, a sequence of bullish candles, and now a turnaround of this market is very likely. A final example here, you can see the market was in an uptrend here after the market trended lower. You'll see that here the market picked up bullish momentum. We have a slow acceleration, so here very small candles, but then suddenly they got bigger and bigger and bigger until here we suddenly have bearish candles again. We also have deceleration, very small candles. Now the distribution between bullish and bearish candles has changed as well. Previously there were no bearish candles at all. Suddenly you have bearish candles, and then now we have more and stronger bearish candles. So you can see the market is clearly now in a downtrend, and you will often see how this acceleration and then the deceleration after a trend and then the acceleration into a new trend, you will often see this pattern time and time again. Price divergences, number 2. So we look at it's an extended momentum concept. We look at swing points and price waves. We look at how easy does the price break into a new high or low, and how strong are price waves in general. This will help us to build on top of what we have already covered in the previous point. So when we take a look here at this downtrend, you can see it's a very strong downtrend. And what we want to do is we want to take a look at the highs and the lows. And you can see in a downtrend, the market will consecutively make lower low after lower low after lower low after lower low. At the same time, the price always made lower highs. At no point in time during this downtrend did the market ever just break this sequence, and never did the market make a higher high as well. Until here, this is where really the powers between the bulls and the bears shift. You can see from here to here, the market barely made a lower low point, very small lower low. And then here you have the first higher high as well. Compare this to this higher high. The first time the market really has made a higher high point. So you have already two little confluence factors, two little factors that are showing you, okay, this downtrend seems to be over. Also, we have a very strong bullish candle here. And then here at this point, we have now the market making a higher low. So we go from lower low and to lower low, barely making a lower low, to now the first time ever making a higher low point. And then the new uptrend starts as soon as the market breaks above the previous high point. So at this point now we have two consecutive highs. Here's the first high, here's the second high, and then the market trades higher, making higher highs and higher lows along the way. So it's really important that you focus on swing points and price waves. If you use, for example, an RSI or stochastic or MACD, you will see that this is going to give you a divergence as well, because the price is actually slowing down. And this is what a divergence tells you. Here as well, the price was in a very strong uptrending market, very strong bullish candles or bullish price waves. You can see that leaving up to the top, very strong bullish push. And then here, the price is barely able to make a higher high. So you can see that we also have concepts of, or the point of deceleration. So the candles are getting smaller and very small here actually after this very weak high. So you can see how this fits together nicely. And then afterwards the market made, the market made lower high after lower high after lower high, and the new downtrend was on its way. So again, very nice how this all fits together. Number 3, which adds also very nicely, are fakeouts. I made a complete video about fakeouts, which you can watch. And let's take a look at fakeouts. And I highlighted those 2 points. You want to look for rejection, and you want to look for a rejection at a key turning point. So this is how it looks in action. You want to really identify key turning points. Where has the market gone from a previous strong uptrend to a downtrend, or a downtrend to an uptrend? You want to identify those on your areas, and the stronger the trend changes, the better. The stronger the trend change, the higher the likelihood that you will see another reaction going forward. And here the market came back into the previous high, overshot it, and not only overshot it, but also made a rejection. So you can see a strong wick pointing up, taking out the complete high, The more the high gets taken out, the better usually, because it shows a very strong rejection. This is also called a bull or a bear trap. And then you can see here we have also some types. First, after this rejection, you have some type of deceleration and then acceleration away from the level. You can see how the candles are actually getting bigger once the market moves away from the level. So very nice how we can put this all together already. Here again, you want to look for strong turning points. The market was in a downtrend, then turned on the spot and started a higher high, started not only high, but a major uptrend. So if you see such turning points where they are at the origin of major trends, you want to focus on those, because clearly the power between the bulls and the bears have shifted here. So you want to put your focus on those. And you can see the market came back into the level. First, the market traded very, very strongly down, very large bearish candles. Then you have the concept of deceleration. The candles are getting smaller. You have a complete rejection here. The market makes a quick dip below the level, gets rejected, and then trades higher again. And you can see that as well here. The strong downtrend gets reversed to a strong uptrend. The market comes back into the previous low and then completely takes out the low. You can see if you zoom in, this is a engulfing candle. So the second candle, the bullish candle, completely engulfs the previous one. Very strong momentum level, deceleration into the level, acceleration away from the level. Here, this would have been quantified as a key turning point as well. But if you extend it going forward, this was not a full rejection. You really want to see that the candle is taking out the previous low. So you want to see that the market goes beyond the previous high point. So this is not a full rejection. Here, another example. Here, a very, very strong turning point. The market shot up, gapped into this level, made another push, and then resumed to the downside. So a very strong turnaround. That's always the first good indication for finding strong levels. And then the market came back into the level, made a rejection. First of all, it looked like the market was ready to break out. So this is something you need to be aware of. Don't just, because the market is trading into a previous high point, don't just enter a trade into the opposite direction. This is not going to work out over the long term. You really need to wait out for rejections. And here you can see afterwards, the market made a huge rejection candle, very, very strong, and then it accelerated away from the level and really started making a lower or a downtrend then afterwards. So fake outs at key rejection or at key turning points previously are a very, very powerful trading tool. Breakout buildup, one of my favorite concepts in price action trading, and we want to look at how does a market behave before a breakout, so pre-breakout buildup. We look for signs that the market cannot pull away from a breakout level. The market or the price basically sticks to the breakout level. Often this happens with an inside bar pre-breakout candle, and the breakout is then often an outside bar. So let's take a look at what this actually means. So here you can see the market was in a downtrend. And then once the downtrend stopped, you can see the market first started making a little bit of higher lows compared to this. We have very nice, well-defined breakout level. So the previous support, you can extend it to here as well. Support turns into resistance and resistance and resistance. So we're waiting for a pre-breakout signal. And you can see here, before the breakout happened, there was actually a small inside bar. So this bar falls into the complete range of the previous candle. It's not able to pull away a lot from the level, and it's also very, very small. This is not enough to enter a trade on its own, obviously. So just because you have a small candle, it doesn't mean that the market will break out. But if the next candle is then a strong breakout candle, you can put the pieces together like a puzzle, and then you can actually make sense of the context of this pattern. So you have the pre-breakout buildup, and then you have a strong breakout here. So everything comes together. The bears are not able to push the price lower, and the bulls completely take over and initiate a high momentum breakout. And then you can see how the market rallied higher. We have more examples. This is something that I traded. You have a strong trend. The trend then faded after a double top. The market made lower highs. Here you can see before the breakout, very, very small candles. Here especially you can see very tiny candles, and then the breakout candle is a huge momentum bar. So acceleration away, and there was no acceleration away from the level before that. But once the breakout happened, there was actually acceleration into the new trend. So you want to look for Small candles before the breakout and then large candles that initiate the breakout. Very, very, very important concept. Here as well, strong downtrend. Then with the price divergence, we were able to see that the market was losing momentum here. The price was barely able to make a lower low point. Here we have a triple bottom. So here the market was not able to make any low at all. So a very weak sign. And then you can see here we have a nicely defined breakout area, and here's the pre-breakout buildup, a very small inside bar here, two small inside bars. Those means that the market is not showing a lot of momentum away from the level. There's not a lot of rejections, so there are not a lot of sellers. And then you can see the breakout actually happens with the gap, and then the new trend accelerates away from the level. And the new breakout, the new trend is initiated with this breakout, which was a little bit foreshadowed by this pre-breakout buildup. So very, very important concept as well. So the 1, 2, 3 fib strategy is something that applies and can be combined with what we have already done. We look at wave building and wave formations. Essentially, this is a pullback strategy approach, and we either look for 1, 2, 3, or if you want to call it an ABC formation. I will show you that, and then we just apply the fib to those patterns. So what you want to look for is, here you have a trend that goes higher and higher, and then here the price is barely able to make a higher high point. So you can see this is the turning point of the trend, where the market is really falling short and not a lot of bullish momentum anymore in the market. Then you have your first trend wave to the downside. So this is your A move, A to B, here's your B point, and then the first pullback in the new trend, this is your A, B, and C pattern. So 1, 2, 3, if you want to call it like this. So you look for the first trend wave into the new trend direction. You can clearly see the market went from making higher highs, barely able to make a higher high, to lower high. And once you can see the first lower high, this is where you apply your 1, 2, 3 fib. So you draw your fib from from A to B. Then you look for, okay, does the price react to a fib? In this case, it did very well. And then you can see the market completes the fib. Usually what happens is that you either get a 138, a 161, or if the trend is very strong, you sometimes even get to a 200 extension. So this is how you could look for target projections if the new trend is really taking place. Usually this happens when the market completes or breaks below the 0 point, the 100 point. So here, if the market makes the breakout, you have a very high chance that you will actually see the 161 or the 200 completion. So here again, the market was in a very, very strong downtrend, lower low, lower low, lower low. And then here was the first higher low point. So you draw your fib from the A move, then the end wave from the first new trend wave. And then here's your C. You can see again, very, very nice reaction to the fib level. So you have your 1, your 2, your 3 here. And then you can see the market went to 161.8 and hasn't made it yet to 200. So again, very nice. And how this would work is that once the market either makes the pullback and you look for a way how to trade the pullback here, or once the market made a move above the 100 again, then you would look for ways how you can set your target at 161.8 or maybe even 200 if you are a little bit more aggressive. But the premise is that you always want to find the first trend wave when the trend has actually turned. So here you can clearly see lower lows to then higher lows, and then the uptrend is started. Let's take a look at a final example. So here the market was shot higher, and then this was not very sustainable, obviously. So this is a huge move. Then there was no follow through afterwards. So the market just completely stopped dead. You can see there's deceleration here at the top. Then there's acceleration away to the new lows. You have your first trend wave now, A, B, C, or 1, 2, 3. Very nice rejection here at the 50 fib level. And then you can see once the market breaks below the 100, it makes its way to the 161, to the 200, and then all the way to the 261. So very nicely how this also works. And again, you look for the first trend wave after the initial trend is over, after you have the actual reversal signs. And the last concept, number 6, supply and demand levels of value. It is very, very important that you are able to spot supply and demand levels. And basically you can boil it down to origins of very strong trending phases. Then there are odds enhancers. You look for major turning points, just like what we did in the beginning when we looked at fake outs. You want to focus on really the big levels, the big events on your charts. I will show you that in a moment. And auto enhancer number 2, you want to also look for a small, obviously there's a typo, and that's not even better. So you want to look for a small build-up before the trend initiation. Sounds much more complicated than it is. Let's get into the charts. So you can see the market was in a strong downtrend, and then there was a strong uptrend. And here was the turning point. And even more important, you have a strong and huge injection of buying momentum here. So here was the origin of this huge breakout candle. And you really want to focus on where's the origin of those huge breakout candles. Those are the price levels where something must have happened here. Suddenly, a lot of buyers came flooded into the market. All the sellers withdrew completely. And then the buyers were easily able to push the price higher. And you can see we want to really focus at the turning points, but usually those areas, they're not at the absolute low or the absolute bottom, but they usually happen a little bit above them. So this is where you would look for a demand area. Very strong area here. Started this uptrend and also is the origin of this breakaway move. And then you wait for the price to get there. In this case, you have a fake out. So you have a fake out together with this supply area or demand area. So a nice confluence level, and the market actually did pick up a lot of buying momentum here and a lot of buying momentum at the low. And then you can see the new trend was started. Here as well, this is classic. You will see those very often. They could be news related. They could be a macro event. It doesn't matter. It just matters that the market went from a strong downtrend and it turned on the spot to a strong uptrend. So really, this is the US dollar yen. So it's a huge market. The Forex market in general is $1 trillion market. So you need to have a lot of buying and a lot of selling power to be able to reverse such a strong trend on the spot. So you really want to focus on those key points. And then you can see the market came back into it, dipped below this briefly, had a little fake out, and then traded higher. Here again, a very strong, previously the market was in a very strong uptrend, reversed, downtrend, sorry, then reversed, downtrend, then reversed, and started a strong uptrend. The market came back into this. Here we have our divergence as well. So we have price divergence. The market went lower low to then here, higher low. And then here we have the breakout. And before the breakout, if you zoom in, there is a build-up. So you have your little pre-breakout build-up, which was point number 4, I think. So you have many things that you can put together: price divergences, acceleration, deceleration, fake outs, value areas of supply and demand. You have pre-breakout build-up. So try to put this to the test, try to put it all together in a sophisticated manner so you can come up with very sophisticated trade ideas, and really let this sink in. Watch this again, leave a comment below, and then let me know if this helps. Leave a thumbs up as well, and then I will make more of those videos in the future. Take care and happy trading.